All right, so welcome everybody. I have got Reed Goossens here, and Reed is going to walk through this really great deal that he has found that we're working on together, this portfolio in Mesa, Arizona, which is in the Phoenix MSA. Reed, I want you to give a little bit of the introduction to the deal, but why don't you introduce yourself first, talk a little bit about your background and track record to set the stage, and we can jump into the deal, and we'll do Q&A.
Yeah, for sure. Thank you and appreciate it. And hello, everyone, and welcome. And if you don't know who I am, my name is Reed Goossens, and I'm originally from Australia. I moved out here in 2012, so 10 years ago now, and I moved out here to really chase a girl. She turned out to be my wife, which is fantastic. But my background's in structural engineering. Moved out here to be an expat. Quickly found myself involved with real estate early on. Bought my first property for $38,000. And then moved into positions in ground up development in Los Angeles in 2014, built a lot of ground up multifamily, and then started syndicating in 2015, was involved early on in Ashcroft Capital's deals. And then I moved on to form a business partnership with Andrew Campbell at Wild On Capital. And we built that to about $650 million of assets under management. I've now pivoted just slightly to start RSN Property Group. RSN Property Group has been around for that entire period of time, but really focusing on geographical diversification after building a portfolio out quite heavily focused on Texas. And I love Texas, but really trying to focus on finding other great opportunities in other markets, Texas, Arizona, Las Vegas, some of the Carolinas, and just be a little bit more geographically diverse. My background, given I'm in structural engineering, I've built out a sort of a supply chain end to end. We buy everything in bulk. It's not rocket science, but we have built that part of the business out. It helps reduce risk to the overall deal and helps reduce the ROI on the turn costs. We've done probably at least a dozen big orders from the Asia markets. And have got that quite down pat, which helps in terms of unit turns. And when I talk about materials, I'm talking everything about the flooring to the granite countertops to cabinetry, really everything besides the paint and the appliances, and maybe some MDF board, for the trim. So overall, go ahead.
Can I just interrupt you for just 1 second? I think this is a really interesting and important point, because there's nobody else in the entire business that I know of. I mean, maybe there are people out there, but I've never even heard of anybody else who's actually their own supplier for materials on these deals, or not their own, but essentially they're doing the export import themselves and getting a big price break on these materials.
Yep.
Do you have any kind of indication as to how much that actually saves, either in sort of like per unit for upgrade costs or whatever? Like what does that actually translate into ROI for your deals?
Yeah, so I actually just gave a presentation at the Best Ever conference on this exact topic. And I was going through some rule of thumb, but looking back at old data, I'm probably getting materials for around, and this is all in per unit, depending on the size of the unit, obviously, because obviously more flooring, more cost, between $850 to $1,200 all in materials. So that includes flooring, granite, plumbing, fixtures, lighting fixtures, door cabinetry, hardware, and then I'm getting my labor for about $6 to $7 a square foot, right? And for the listeners out there who are joining the webinar today, the reason I do this, it was from my background in engineering and working with ground up developers. They do it all themselves. It's not rocket science. It's just it removes the middleman. And so when you're working directly with a GC, you have one less thing on the table to negotiate. You don't have the material piece. It's really just saying, hey, I'm hiring you, GC, to really for labor at that point. It's just labor costs, and saying, I'm going to bring in the containers. It's going to sit on site. We're going to turn the units on 4 to 6 units a month, and that's just how we're going to do it, right? So I started back in 2016 doing this. As soon as I had the first big 192 units, I was like, this makes sense. In terms of the ROI, I'm probably, I just mentioned numbers there, $800 to $1,200 all in materials. So I don't know if you could get the same type of stuff on the street here in the States. So you're probably looking at easily a 40% discount just on the materials, easily. Now, again, different materials come from different areas. And we have seen, and I'm sure there's going to be questions about the cost increase. And again, just the timing of it all. I did the best ever conference, and the big thing I looked at when I look back at my data were really two things. Inflation has slowly grown up over the last 10 to 15 years in terms of cost of materials in the Asian markets, and we're coming directly from China and Taiwan. Labor on the ground in those markets has also increased, but the big one that's increased is shipping costs. Throughout the pandemic, pre-pandemic, I was getting a 40-foot container landed here in the US on site for about $5,000, $6,000. During the pandemic, and not as much now, but I remember I think I had 80 units worth of granite come out, and it cost me about $20,000. It cost $28,000 just in the shipping cost. So you've gone from 5 to 28. That obviously increases your overall number, but I can't get that any cheaper on the street here in the United States.
Yeah, and probably significantly more expensive, I would imagine, because
That's
you're paying some developer or some contractor's markup on that material.
Yep.
Right. So,
yep. And the thing is, people will probably ask, and just to preempt the questions, well, what do you see? It's like, well, I don't see it going back to $5,000. I see it coming back down to probably about 10 to 12,000. And the reason that it went up so much was because during the pandemic, a lot of shipping companies, if they stay idle, they operate on very fine margins. They stay idle for a month, they're losing dollars. So they scrapped all their containers. Less ships on the water. Less ships means high demand, high pricing. So there's a lot of shipping companies coming back to the market. And again, I don't want to get into shipping supply chain issues, but some of the things to help your audience understand what I'm looking at to try and squeeze the dollar in the right way, and not just, blindly give it over to the property management company and they do the renovations.
And in addition to which, this is a question I wanted to ask you later, but I'll just ask it now since we're on the topic. In addition to being able to construct your own supply chain, essentially, what else does your background working, as a structural engineer, what are the other ways in which that helps you do what you do? You're doing heavy value add, repositioning type deals. They're not exactly construction, but there's a lot of construction involved. How does this background kind of give you an advantage over, most of the people in our business?
I think the biggest thing is people are scared of older vintage assets. I personally am not. One of these assets we're going to talk about there is built in the 60s. People would run to the hills, but even lenders run to the hills. But I've built stuff in London and rehab stuff in New York and LA. The house I live in Los Angeles was built in 1912, and I didn't rip it down. I went in and gave it love, and it's now new electrical, new roof, new HVAC, and all that sort of stuff. I've reduced the risk. Now that house can now go on for another 25 years because it's got new bones. So when I look at these older assets, there's two things that really come to mind. One is that typically these older assets are in better located areas. So stuff that was built in the 60s and 70s, is obviously gentrified and cities have grown around it. So you typically have very well located assets. The second thing is that we're not in my opinion, we're not we don't need more Class A properties, right? We don't need the more $2,500 rents. We need those workforce housing rents, the $1,000 to $1,500. And Mesa portfolio being one of them is well located, backs into the demographic who lives in the area. They can afford this. And it's not about, we want to rip this property down and rebuild because you just couldn't do it at the same price. It's more that coming in and just understanding, well, what are the risks here? Okay. Well, one of the things I like about, and I'm sort of segueing into the deal, is this particular asset, the Parkside, which was the older of the two, it has complete new roofs. The new roofs were just replaced. It has a new boiler, new chiller system, new siding, and new paint as of 2016. So you're not actually buying a 1960s asset. You're buying something with good bones, that the risk of these big scary things going kaput, i.e. a chiller, i.e. a boiler, is drastically reduced because they've already been replaced and they're essentially brand new. The second thing is that, and it depends on where you are in the country, different products, stuff that was built in the 60s and 70s was typically built out of what's called CMU, cement masonry units, which is block construction. Stuff in the 80s and in the 90s, they shifted more to stucco and wood. And so you actually get a better quality product in your earlier stuff because it's just made out of block rather than made out of wood. So again, it doesn't scare me when I see these things, because as long as we've got the right budget for it, should something go wrong, i.e. plumbing or HVAC system or a chiller system, then we can replace it. And again, it's not about coming and demolishing these older assets in well-located areas, because the fact is, if you came and tried to rebuild the Parkside, a 3-story block construction, you're probably spending over $400,000 a door. We're picking this up in this particular market. That is, we're picking this deal up at $220, $225 a door. So there's just still a gap between we really do I need to replace that asset, or do I just need to come put love into that asset because people still need that $1,000 to $1,500 rents.
Right, so that's a great segue, a great place to jump off into the deal itself. So why don't we go into that? Do you want to share your screen, or do you want to just talk about it?
I know you do. I can share my screen, and I'd have to just pull up the one that I shared with you.
Yeah.
Jonathan. And did you have any comments to that last one I sent you, by the way?
No.
I did. Perfect. Okay. All right. So we're going to share our screen. Can everyone see that?
Yeah, I can see it. So
perfect. Okay. So the story behind these both deals. So the one on the bottom is River Rock. It was built in the mid-'80s. It was actually built as a condominium project. It's only 48 units. And the reason I found this deal was because I had a bit of personal cash that I needed to place that I needed to buy. So I was looking to buy something in the sort of $12 to $15 million range. And this deal came up with one of the brokers I was working with. And he's like, look, this is a smaller deal. It's only 48 units. It's off market. And I said, oh, great. Let's go see if the numbers work. So the River Rock has larger floor plans. Again, it was built in the 80s for a condominium. It never got converted into condominiums. And then we found out through the broker is that the Parkside was also owned by the same owner, and they were also thinking about selling or getting an exit. So I said, well, maybe we go and tie them both up. They're only within half a mile of one another. Let's and we go syndicate the deal. For me personally, I'm putting over $1 million of my own money into these deals. Because I still have that problem of I've got to deploy capital. But the story started with me trying to hunt for a deal for myself. So that's the overall story there of the deal. Myself, we just spoke about, I'm the founder and CEO of RSN Property Group. I've built a portfolio of $650 million worth of assets under management. We spoke briefly about my structural engineering background, some of the things that I'm bringing into the business. Obviously, Jonathan. And this is sort of the we call it fully integrated platform. As much as we can be integrated as best as possible, and it comes down to everything from how we underwrite deals. And part of having 8 years experience in the syndication business, I've successfully cycled 6 deals. I've looked at hundreds and hundreds of deals over the years. Is that I've really been able to refine my acquisitions approach. So we have been looking in the Phoenix market for some time now. So the Mesa deals have probably been, we probably looked at 60 or 70 deals in the last 18 months to try and find these deals. Some of the people listening to this recording will know that it ain't sexy when you're trying to enter a new market, trying to hang around the hoop. But if you hang around the hoop long enough, you underwrite deals consistently, you give them feedback, you start to get those rebounds, right? And that's what I'm starting to see. I've got a head of acquisitions who lives in Phoenix, and he and I have walked a ton of deals, in the Phoenix heat. But it comes down to, this is the game you've got to play to, you're in it for the long term, right? You're hanging around the hoop, you're going to get that rebound, and this is an example of the efforts we've spent over the last 18 months to try and penetrate this market. We spoke about the in-house, the deal sourcing of materials. There's construction management, which is obviously one of my not passion. It's a passion of mine, but it's also what I bring from my former life. I was involved quite heavily with ground up construction here in Los Angeles before I got into syndications, and that again I bring that sort of institutional quality of management, and then again asset management as well as what we oversee in house.
I want to make a point on this too, because I would say most people who are in the syndication business, if they're doing any kind of like rehab, repositioning, they're just essentially handing it over to the property manager, paying the property manager a fee to be the construction manager also, and
right.
just checking in sort of as best they can, and probably as best they can means like, how many units did you get done? You're actually able to run this process yourself because this is what you did for a living before doing syndication.
That's
So I just want to emphasize sort of the, how different that is from your typical syndication deal. That you're actually
that is correct, and thank you for bringing that up. Look, there's two reasons I like to do that. One is just because I have that experience. Two, it's just managing people. But three, you really get. I don't want the property management focused on things that may not be the best for the deal, i.e., meaning let's get them focused on pushing that rent. Let's get them focused on reducing that delinquency. Let's get them focused on making sure that the property is occupied. I'd rather have that team focused on that rather than one eye how do I make an extra buck here and there for every single turn. So I just try to separate them to make sure that, hey, like we're working we're having a sort of a symbiotic relationship where, in terms of they would advise our team, our GC team, like, hey, there's 3 units coming up this available this month, but they're not focused on having to implement, again, find the materials and source all that and negotiate with the GC and the contracts and all that sort of stuff. That's what I take on.
Awesome. So sorry to interrupt you, but I just thought that was an important point to emphasize.
No, thank you. So CalCap Properties is our boots on the ground property management team. I first was introduced to CalCap about 18 months ago with another deal. One of my former students, he took down a 67 unit deal in Phoenix, which I was involved with as a co-GP. And I was able to observe them, to see where they did. When I approached them to say, and I will say, the majority of my portfolio is in Texas, using a different property management company. That property management company, Roscoe Properties, love them to bits. They are in Phoenix, but they're only just getting started in Phoenix. They didn't have the depth of knowledge that CalCap had, right? And that's a lesson to all aspiring syndicators is part of the reason that I still do third-party property management is that I can never replace the people who run CalCap. They've been in the business for 25 years. They've been in Phoenix for 25 years. They know every deal that's been cycled. So when I come to them and say, hey, do you know of the Parkside? Do you know of River Rock? They said, oh yeah, of course I know those deals. We used to manage them. And so part of the story here is that they, through my other, my other deals, I was able to, one, see how they performed, two, enjoy that they had a really good depth of knowledge in the market, but then three, coincidentally, they happen to know the deals really well because I used to manage them. So it sort of all fell in line. And I bring up Roscoe because Roscoe was, the incumbent. I'm going to a new market, building out more portfolios in different markets. Of course, I'm going to use Roscoe. They're here, but they didn't have, because they were fresh to the market, they didn't have the knowledge that CalCap had. So again, important lessons when you're building out your boots on the ground. You really want to employ the team that has, one, the knowledge, but two, also the depth of bench to attract good talent, and also have a depth of bench in terms of just connections in the market and broker relationships and just the understanding of how things are trading for, which is really quite vital in this business.
Yeah, and I think it's really important, my experience too, as a sponsor of deals, working with third-party management, is that having somebody who really has boots on the ground is important, because when you take over an asset, you need them to be able to hire quickly. You need them to know who the good people are in the market, right, and who the bad people are in the market. They're going to get a lot of resumes, and people with long track records, they know the people who have bad reps in the market already, and they just pitch those resumes when they come in the door. Right. And you can't do that. Whether you were going to come in and try to self-manage, or whether you're bringing in a management company that you have a relationship with from outside, like neither of those two, you or that other manager, have got that ability. And these folks, 25 years in the market, I mean, that's just a very different infrastructure and different experience that they have.
That's right. And also, these are slightly smaller deals. One's a 48, one's an 87 unit. CalCap only manages 5,000 units. Roscoe has 60,000 units across the country. It's just a different beast, right? They're not going to be able to manage them as effectively on the smaller side because they have just so much more infrastructure on the back end. And again, I'm not trying to beat up Roscoe Property Management. I'm just trying to compare the two as an owner to say, okay, well, also how do you run these smaller assets, because they just takes a little bit different understanding. So yeah, bit of track record, deals sold. I will preface by past performance is no indication by future performance, but there's experience there. Clearly, when we've come the last 12 months, we've been very successful in cycling deals and getting a really nice return to our investors.
Do you probably don't have this off the top of your head, but to the extent that you recall, and with the caveat that memory is what it is, can you talk about sort of the dollar size of some of these deals?
Yeah, sure. Yeah. So Henry B and Blair, we purchased them as a two-pack again. So I've got experience buying in two packs. The beauty of two packs is that you structure them in a certain way that you could have multiple exits. We bought them together. We sold them together. We purchased the Henry B and the Blair for I think 32 million, and we sold it for 42. We sold it for 42 million. So I think we bought them like roughly 85K a door. We sold them for 116 a door. The Joseph, that was my first ever baby. I know that deal very, very well. We bought that for 16.1 million, and we sold that recently for 28.2 million. The Baxter in Austin, we bought that for around, I think, again, 42 million, and we just sold it for 65 million. Reserve, we bought that at, I think, 130K a door and just exited at 180K a door. And the Lila is under contract right now, is selling, and we bought that at $20 million a door, and so we bought it at 84K a door and now selling it at 155 a door.
And what about increase in NOI for these deals, to the extent that again?
Yep. Yeah. So I believe on the Henry B and the Blair, we had in that period of 30 months, I think we increased roughly about 30% in that short period of time. And we had a bunch of, and I'm an open book. I had issues on both those deals, doing things that just go wrong that you just got to handle, right? But you still, that's part of being hands-on. I pride myself at being hands-on in each and any one of these deals. The Joseph, we had over 50% NOI increase over a 4.5 year period, so roughly 10% a year. The Baxter, I think that I'm sort of getting more vague here on the lower deals, but you're roughly shooting in between like 10% NOI, 10 to 15% NOI growth per year. Mm-hmm. So that's typically what we're seeing.
Thanks. Yeah.
Okay. This again is just an overview of active markets I'm in, both in a personal sense in the portfolio, and in the blue markets, the markets I want to enter, and really offering diversification. And the premise of that is really to it comes from when you're looking at when deals are getting tighter and tighter to find, you just got to cast the net a little bit wider. So having having good relationships in those markets takes time, and that's part of what I do. But that's also part of the business. So yeah, just in terms of trying to grow this, what I've built out in Central Texas across the country. And the other thing is that we have warehouse. Back to the shipping, we have warehouses in Dallas, which is always where it's been. We can ship across the country, so we've got that sort of US side figured out. So overall, the deals, we're purchasing these at $33 million. It's 135 units. We're shooting in the sort of mid 15 IRRs, over a 5 year period. The average cash on cash is about 5% over that period of time. It's located in a really, close to fast growing town in Mesa, Phoenix. If anyone is familiar with the Phoenix area, Scottsdale and Tempe is really where the university is, the university kids. Scottsdale is sort of the hip area, as Mesa is sort of to the east of Tempe. And it is, and then you're Glendale to the west. Glendale's a little rougher. Mesa is a little nicer, and you see a lot of gentrification happening that way. Facebook is just about to break ground, or has broken ground on a big data center there. There's also a huge $200 million investment between ASU and the local Mesa City Council on, not revitalizing, but putting in good infrastructure to attract certain types of candidates to the ASU campus in and around. I believe they're really focusing on media production and trying to be sort of the back end of Hollywood, so to speak. And then your break-even occupancy, and we've got a really good mix here of studios, 1 beds, 2 beds, and 2 baths here as well. And the total equity we're raising is about $13.4 million. And yes, we are taking 1031 exchange investors. So again, it's located in really the hub of these sort of 3 loops that sort of go around the Phoenix area: Loop 101, 202, and the 60. And then being close to downtown Mesa where the light rail is. So a lot of people have very good access in and around to other hubs within, the Tempes and the Scottsdales of the world, and they're not too far away from them. I think the big thing that really sells this deal is Phoenix. You hear a lot in the headlines, Phoenix and Austin seem to be trading for the growth. But over the last couple of years, they've seen over 26% rental growth in that area. That's because of the affordability. That's because of people moving from California and other states to a state where the weather's over 360 days a year of sunshine or something like that. So it's attracting a lot of people for its affordability, and that's really what we're trying to ride the coattails of. The big thing here, back to the thesis, is quickly to grow in-place rents. So the in-place rents today are around $1,000 to $1,100, depending on the unit size. The similar comps, similar vintage renovated are sort of in between $1,500 to $1,600, again, depending on the unit size. So there is immediate meat here to go in and really increase that rental rate, coupled with the fact that we have experience with CalCap. They have given us their pro formas for year 1. They really think we can push into that sort of $1,400, $1,500 in year 1, and then continue to push that in year 2. So just immediate upside in coming and really focusing on the interior renovation program. I think the other thing is we're buying them together, right? So we're buying as 2 deals. We have the option. So 2 things. The reason why we're buying them together is that if you bought them individually, there would be sub $20 million in debt. You get less participants in the debt market when it's sub $20 million. So to buying them together, so just made a little bit more sense from the debt market, slightly better terms. But also it means we can, if we want to sell one, keep one, we want to sell them together, we sell one now, sell one later. There's just many options that we can do buying them sort of in a 2-pack. And really the biggest thing is the operational efficiencies. They're only half a mile from one another. The River Rock is only 48 units. It's built like a condo. There's no office on site. So we're going to run that as more like a virtual leasing type of thing out of the Parkside asset. Again, my experience with building a portfolio. The thing I touched on earlier, which was, they're both really, really well maintained. Issues that you may have to come in and deal with on an older asset, HVACs and boilers and roofs and siding issues have all been handled within the last 4 to 5 years. And the ownership prior to this current ownership was a well-known local owner named Terrence Barry. And he and his wife actually owned both of these assets for over 25 years. So they took really, really good care of both assets. And then the last thing, obviously hit on is the bonus depreciation is coming to an end, which is what a lot of people invest in real estate for.
Yeah, can you want to just explain that you're going to do cost segregation and bonus depreciation on this asset?
Yep. So every single deal that we buy, we get 2 studies done. The study done when we take over the asset sort of does the as is, what we can depreciate today, and we do accelerated depreciation, including the bonus depreciation, and then we get them to come back a year later once we've sort of implemented the vast majority of our capital expenditure plan, to do another cost segregation to sort of capture those additions in year 2, if that makes sense. So the offering, again, we're having 1 set of investors here. If you've invested in other deals, with Class A, Class B, these were sort of a bit on the smaller side, so it didn't really make sense. So it's 1 set of investors. It's an 8% preferred return for those people. I'm sure most people know what that is. And then, any profits split thereafter 70-30, once you were paid back your initial capital. Now, we do believe, based on our underwriting, that we are, we will not hit the 8% throughout the hold. That's why it accrues. And you'll see that later on in future projections.
Yeah, so just slow that down a little bit, just so people who
Mhm.
don't understand, because you'd say it's 5% cash on cash with an 8% preferred return. That
Yep.
means that the gap is going to accrue and will be repaid at some kind of liquidity event, like a
Correct.
refi or sale or what have you, but
That's
it
correct.
will be caught up before we go to the split.
That's right. That's
Yeah.
right. Yep. And a lot of people ask, well, when do you get paid? Well, it's after that 8% pref is paid, right? We don't get to participate until we've paid you back your initial capital. We've paid any unpaid pref is caught up, and then any profits thereafter is split 70-30. Okay, unit renovations, we spoke a lot about. There's over 90% of the units are classic units today. There's over $1 million have been spent in exterior deferred maintenance. So really we can focus on coming in and upgrading the amenities. The amenities on both assets are lackluster. They've done a bit of exterior painting. That's about it. The pools are pretty average in my opinion. So really what we're focusing on is coming in and really putting a bit of money into those amenities, dog parks, children's parks, astroturfs, cabanas, that sort of stuff. Really make it feel like an awesome place to live. And then really look at the operational upside in terms of managing with so close to one another. We have underwritten them as if they're individual deals. And I know I shared some data with Jonathan the other day because there was a couple of questions in and around the percentage of operational expenses to income, and we'll get onto that in a little bit. But part of the big thing is really coming in and implementing out what I like to call the platinum level upgrades, which is granite countertops, new cabinets, tile backsplashes, Nest thermostats, stainless steel appliances. We're going to do keyless door hardware on the River Rock asset, given that we're going to try and do more virtual leasing over there, and focus on other sort of revenue generating items like trash valet, like coming in and putting in washer dryer connections within every unit at Parkside, coming in and putting an internet package on both assets. So and all these things I've done before in previous deals. Internet packages I've done before, washer dryers I've done before. They're just things that people like to have in their unit. And then just one of the other things I love doing is putting in low flow toilets and low flow shower heads. They have sort of a really big ROI from day one. Any questions here, Jonathan, before I move on?
Well, yeah, we'll keep going. There are some questions, but I think they're kind of better for later.
Yep.
Yeah.
So, exit strategies, we're going to hold for 5 years. We've got flexible debt. We've got strong job growth dynamics. Our conservative underwriting. So we have, we're sort of averaging at 3.25% rental growth once we get to sort of the market rent over the next 5 years. They're saying, according to RealPage, that we're still going to be in the double-digit figures over the next 2 to 3 years in Phoenix market. Again, trying to be conservative and hold back a little bit. We don't want to be the highest in the market, but we really want to keep within that range that the median household income can afford within this area, right? And so roughly we focus on part of our investment thesis is, okay, well, if I'm going to try and push rents to $1,500, I need to be in areas where, where household incomes are between $45,000 and $65,000, right? I'm in that class B type of neighborhood that is transitioning and has a lot of, good infrastructure being invested into it, i.e. with the Facebooks of the world and the city of Mesas, partnering up with ASUs and investing in itself. And that's really what I want to look for as an operator, because we can ride those coattails. A little bit of a snapshot of the classic units versus an example of a renovated unit. So again, you can see the differences between the two. It's still, the left-hand side, there's nothing wrong with the left-hand side. It's just tired, right? Tired and dated, and got original cabinetry. So yeah.
What are you going to be investing per unit in these kinds of upgrades?
Yeah, so roughly about $13,000 per unit, and that is inclusive of what I've seen in terms of the material cost increases and all that sort of stuff. Historically, back in the day, I probably would have got that done for $8,500. Today it has increased. And then on the exterior, so I think that's rough. And I've got this. Yeah, we go. Here's the next one. So there we go. So again, we're not doing all the units. It's penciling out to be about $11,000. But if the units we actually do turn, it's about $13,000. And so overall, spending about $21,000 a door. I've spent 2 days on site in the DD as of last week. So two things, that I've learned is, we've crawled all over the asset. I think we've got a little bit of fat in the exterior budget, to be honest, which is a good thing. I'd rather have too much money than not enough. But the second thing is that we're already actually achieving with the recent rents they just have signed up, the current ownership, they're already at a pro forma, some of them are already at a pro forma rents, and we haven't, and those are on classic units. So again, goes back to the strength of the Phoenix market and how much things are growing very quickly, and really just trying to bring everything up to where the market is. So the debt, the big one is the debt, right? Everyone is very concerned about the debt today in and around what's happening. So we have been quoted about 69% on the purchase price. And then we've been offered 100% CapEx dollars, but I don't like to take 100% CapEx dollars. And the reason is I want to be conservative, but also want to be able to control the process. Raising some dollars from CapEx is important because it helps me get out of the gate, right? I'm not reliant upon the bank, giving me money, a handout. It's like flipping a house, right? You've got to get started with some of your own cash. The initial interest rates we've been quoted is around between the spread today is between 365 to 375 over SOFR. The model does include the SOFR curve. So for those people who are listening and maybe not understand what the SOFR curve is, places like Pensford and Chatham Financials, these are financial institutional firms that sort of show a prediction of where interest rates are going to go in the next 2 to 3 years. And if you look at, when we get to the pro forma summary, you'll see the debt numbers increases in year 2, and then it comes back down again. It's because the model is following the curve of what they predict. Now that's a prediction. It could be less than that. It could be worse than that. Well, in the case that it is worse than that, we have a rate cap on there, meaning interest rates will never go above 6%. And we're going to go buy a rate cap when we can. Again, the reason people might be asking, why aren't you buying fixed rate debt? Well, I have bought fixed rate debt in the past. 2 of the deals that I just mentioned on the previous slides, one of my very first deals that I bought back in 2016, 17, I bought fixed rate debt. I've been in this situation before where we thought interest rates were going to the moon, got it. And then I had massive prepays, right? I had big defeasances. Even today, when I sold the Joseph, which was one of those, my first ever deal, I sold it earlier this year when I was over 5 years of ownership on a 7-year fixed at 4.35%. It cost me $1.2 million to break that loan. So that's on a $28 million deal, right? So going and paying a rate cap of say $300,000 to $400,000 today versus paying $1 million on the back end when I come to try and break or exit early, it's kind of a no-brainer. It still allows us the most flexibility. Again, because we're buying 2 assets, can we sell them together? Can we sell them individually? And we only have an 18-month lockout and no prepay thereafter.
So this is a good place to ask one of the questions that has come up, which is one of the potential exits to refi and return capital? If so, when would you do that? Just talk about that possibility a little bit.
Yeah, look, given my experience, so 2 things I don't do in my models, and nor are these models based on this, is modeling a refi. I don't ever want to do that. I believe as a sponsor, it is great to try and have a goal of doing that, or whether it's a refi or if it's a supplemental loan if you get a fixed rate debt. But overall, my goal isn't to refi everyone's money out, because I also think that I need to be realistic with where this market is going. I think we're sort of coming to a bit of a, we've had these huge rental increases, which I believe are going to sort of plateau out, and we're still going to really focus on the value add. So right now, I'm not expecting to get a cash out refi of 80% of investors' money. I think that the safest bet, and given my experience, is just we get to sort of use 2 or use 3 or even year 4 and look for a sale at that point. Again, I don't want to ever promise a refi. It's up my sleeve if I do, but if I promise something and I get to that year and we can't execute because the market's different, then I don't want to have egg on my face as an operator. Does that answer that question?
Absolutely. Yeah. Thank you.
We spoke about cost segregation earlier. We're definitely doing cost segregation, 100% bonus depreciation. We use KPKG out of Pasadena, California. We've used them multiple times. They do fantastic work for us. Again, we have them coming in 2 times throughout the hold, once right on day 1, and then 12 months later to sort of maximize the capital expenditure we've spent over the last 12 months in that sort of year 2 K1.
What's the name of that company again? The cost side company?
KBKG, I believe it is. Yeah, KB. K for Kate, B for Bob, K for Kate, G for George.
Thanks.
I lost my train of thought there, but I was just going to say about that. I'll come back to that. It was all about cost segregation, but I'll hopefully remember this. So property overview, again, this is we'll call it the smaller of the two, River Rock. Because we are operating them together, we will be rebranding them to the Bronte East and the Bronte West. They're within, so close to one another, they can be operated like that. So we'll completely rebrand the asset, relogo it, make it feel like it is a sister asset. The smaller of the two, as you can see, in-place rents today are about $11.50, and we're trying to push them to $16.50. This has all been backed up by not only our own research, which is in the deck, but by CalCaps and by other market data that's out there that we're seeing. Again, it doesn't have a lot of amenities on this asset. There is a space at the back of the asset to add a dog park, kids playground, and a small barbecue area. So that's what we're going to do. Over on Parkside, it's a 3-story building. Again, in-place rents are about a bit over $1,000. We're trying to push them to about $13.50. Again, all backed up by hard data and evidence. Again, boilers, chillers were all replaced within the last 5 years, drastically reducing the risk of any of those issues becoming a further issue. And so really we can focus on finishing out the exteriors, coming in, updating the pools, putting in a new barbecue area, putting in carports, rebranding, and then focusing more on the value add of the interiors. And this is the asset we're going to add the washer dryers to. Okay, financial analysis here. We have looking at about a 35 to 65% debt coverage ratio. You can see here from operations, so back to your question earlier, Jonathan, about the pref. So, year one, we're sort of predicting about a 2.75% cash on cash. Year two, just slightly shy of 4%. Year three, as you can see there. So the fact that we don't hit 8% year one means it accrues. So we take that sort of the delta and say, okay, we've got to put that, we owe it to them. In year two, it's the same thing. Year three is the same thing. And then, if we sell in year three, well, it'll be 3 years of catch up that we owe. If we sell in year four, it'll be 4 years of catch up. If we sell in year five, it'll be 5 years of catch up. And then whatever's left over is split 70-30 thereafter. And that really protects investors because, if we sell and we only hit your 8% pref, well, then we as the GPs don't get paid, right? And that's, we're very much in alignment with making sure the deal does perform. But go ahead.
Yeah, I was going to ask just one thing that you and I talked about this in our previous discussions about the deal, about the expense ratio. I hear it is about 31%. It's a very, very good expense ratio. I've often found that hard to achieve. You had sort of very good explanation as to why the expense ratio is so good here, but I maybe you're going to get to that. I didn't mean to skip ahead, but
that is a big one. And so to a couple of things that I've shared with Jonathan for everyone who is not aware. So firstly, I've shared with him. I'm more than happy to share with you guys as well. CalCap's projections of year one, they're a lot higher than what our projections are. Probably in and around about 15 to 20% higher in NOI. They're all their expenses are actually lower than what my expenses are. And the big thing that drives these expenses in these areas is that about 3 to 5 years ago, it's the state of Arizona put a sort of limit on what they call an LPV, sort of I was trying to pull up here on my phone my explanation that I sent to you, so I'm not sounding like a complete idiot. But ultimately there is a cap on how much they can increase real estate taxes, right? So the big thing that you're missing here, if you compare this to say a deal in South Carolina or a deal in Texas, where your real estate taxes are sort of 25% of your P&L, well, you can look here that the real estate taxes are quite a lot lower than that. And it's all to do with this sort of cap on how much the state of Arizona can really hit you with increasing your real estate taxes. So overall, that's the big driver here. The second thing is it's also a lot, the insurance on the insurance side is a lot lower. It's 365 days of sunshine. They don't have a lot of tornadoes. They don't have a lot of weather events like I've experienced in Texas with like the winter freeze and stuff like that. So I've operated in markets like Texas. Part of the reasons I love Texas, but the real estate taxes and the insurance are starting to get so high that I can't really afford to, it doesn't pencil anymore. So looking at states like this is really the reason why I've sort of come to Phoenix. You'll also notice that, on the price per pound, given that these real estate taxes and insurance, you can sort of hang your hat on a little bit more compared to, say, Texas, where you don't know where the insurance is going to go. Like on one of our deals, we just had a 35% increase in insurance premiums. It's ridiculous. Is that you'll find that an 80s asset in Phoenix will trade at a higher price per pound, price per door, than an 80s asset in Texas because of those reasons, because of the variability in two major line items in the P&L. The final thing I'll add is that I already operate a deal in Phoenix, a 67 units, so very similar to this. It's operating sort of around the $4,500 range. And I shared with Jonathan, my debt broker at Brocadia, sent me a bunch of data on other deals within a sort of a 5-mile radius of this asset, and we're in the 85th percentile of expenses. He was like, "Look, you're really, really high. Here's some data, but I want to be high, right? I want to operate it, where I think we can be successful, and two, I don't want to starve the asset of decent operating expenses so we can't hit our rental premiums."
Right. So meaning, just to be clear about this, so 85%, 85th percentile of expenses means that there are only 15% of the properties out there that have higher expenses than you've underwritten here, right?
Correct.
Per door.
Correct.
So even though your expense ratio on the deal is very low, your per door expenses are not just consistent with the market, but you're underwriting on the high side. So that means you're underwriting really conservatively. Which gives me a lot of comfort. I also think one of the things that I like that I see here is that you're basically you're raising every single expense category here, except for there's a couple things here. What's that?
Utilities.
Yes, exactly. So utilities are going down. I also see utility reimbursements are going down. For the people who are looking at that and going, okay, what's going on here? Why don't you explain what's going on here?
Yeah. So the big one is low flow toilets, right? That's the big thing, is coming in and putting those low flow toilets on there. I'm not going to have as big expense, but I'm also not going to have as much utility income, which is sort of, it's a win-win situation for all of us because we don't have to pay as much, but then the tenant doesn't have to pay as much. And it's very, very effective. On a couple of my other assets I've had in Texas and in other markets, I've reduced the water bill by, from $15,000 a month down to, $8,000 or $9,000 a month, literally in 1 month. So the expense of coming in and spending $300-400 a door, putting in the new toilets, putting the low flow showers and faucet knobs really has a massive impact and an immediate impact on the deal itself.
Awesome. Thank you for that.
Okay. We mentioned earlier the debt service. This is where the debt service, it sort of jumps up in year 2, then sort of comes back down in year 3. Again, it's based on the SOFR curve, and that is why we do that based on our modeling. I'm not going to get into too much of this, but it's just some verbiage in and around our underwriting expenses and what we've chosen to do in certain areas. Market overview. Again, this is a lot of data here. I'm not going to get into too much of this, but again, you can read it at your leisurely pace. But one of the big takeaways for me is the continued population growth, the continued job growth, and the continued job growth and growth in over 6-figure incomes as well. I think it was another stat based on that I found the other day. So a lot of high-paying jobs are moving to this market because of the relatively low cost of living. That will have an effect on the local economy in a good way. I know places, houses in the Mesa area have grown over 30% in the last 2 years since COVID, because there's a lot more demand, but also the cost of inflation has gone up. And then the demographic data. I like to look again at this sort of average household income, right, trying to be around the $45,000 to $65,000 range, that they can afford the $1,400-1,500 rent on a 3 times income sort of ratio. And this is expected to grow significantly in the next couple of years. In terms of the rental comps, this is River Rock. So again, you can see we've got some slightly newer assets here, but we've got older. The Equinox and Country Club is actually a former student of mine. They own literally across the street. We have very similar size units. They're getting $1,700 for their units straight out of the gate, right? On a similar vintage asset. It's a slightly older vintage asset. So we're going to come in and try and get around, I think it was 1650. Sorry, yeah, 1650 is the goal. The weighted average is 1640 today. Our 1650 we're going to try and achieve in the next 18 months. So the market will also increase as we're trying to get it up to that 1650. So I'm not trying to say 1650 is tomorrow. 1650 is sort of a goalpost in 18 months' time, when we also believe the market will still continue to grow at a rate of, based on the data we're reading, they're still saying double digits. I'm sort of assuming that it's going to be roughly around 3 to 4%. Parkside, different vintage asset again. So you got to compare it to its other assets. So again, the average on the studios, there's some good deltas here. Again, we've got bigger units. This place like the Link, again, getting about $1,100. We're assuming about $1,050. Again, not today, but in 18 months' time. The same with 1 bedrooms and two bedrooms. And then the sales comps, we've got some good data on the sales comps. We're getting it at a slight discount on the price per square foot, but a good discount on the price per unit. And we've got to look at both of those pieces of data to make sure that we're not overpaying in the current environment today. So yeah. So with that all being said, questions. I guess we'll stop here and go to questions.
Well, yeah. So one that I had was just about the hold period. Sort of what do you anticipate there? I mean, we talked a little bit about it in terms of refi and stuff, but what are you projecting?
Yeah, I think for me, it's what I'm seeing in markets is that probably at the minimum 2 years. I think that we're technically we're already sort of started this the R word. So I think we'll ride it out and get through the other end. So 2 to 3 years would be on the minimum end, and then obviously 5 years. We wouldn't hold any longer than 5 years. I will, like all my deals, if you go back to my exit analysis on the proven track record, I think we've averaged around 36 months hold period, even though we always say we're going to hold for 5 years. We're always constantly looking to get BOVs, broker opinion of values, every year to try and keep up with the market, make sure that we are getting the latest and greatest.
What about the opportunity, or maybe this is just sort of thinking too far ahead, of doing 1031 at the sale? Yeah. Well,
100%. So we're allowing 1031 investors to come in, and so on the sale, yes, there'll also be opportunity to 1031 into other deals, and we hope that we're going to buy some more deals in the Mesa area over the next 2 to 3 years, so we could sell it maybe as more of a smaller portfolio. So yeah, there's a lot of opportunities there that we want to continue to grow in this market.
Who else? Well, we had one question which I answered, but I'll just speak to it too. Somebody had said, you mentioned Class A shares in the deck, which implies the existence of other shares, other categories of shares. So what? Can you just run through that structure a little bit?
There's not, and it's funny. Someone mentioned that to me the other day. I was like, no, just one class. There is a second class. It's Class B, and that's going to be the GP, right? So there is a second class. It's just we're the general partnership. So hence the GP here. Maybe I should have put in parentheses B, but hopefully this stack is quite clear. Is that there's a debt gets paid first, then any LPs, Class A LPs, and then GPs, which is Class B LPs, get paid after the 8% pref, and you get caught up all your money.
We've got another question that snuck into the Q&A rather than chat. So what is this? I noticed the exit cap projection is 4.6. Mm-hmm. Rates at the time are projected to be at the rate cap of 6%. How do you expect to sell at a cap rate well below debt rates on a stabilized asset? So I think what the question is assuming that you're assuming a 6% interest rate at the time of exit, but I'm not sure that you're assuming
No,
6%
I'm
interest?
not.
You're just,
I'm not.
just
I'm not
cap-
assuming.
yeah.
I'm not assuming a 6% interest at exit in year 5 at all. And again, it goes back to the.
Yeah, we have that. You have that projection from.
Yeah, and there's also the sensitivity analysis here. So I implore people to look at. We've got a change in sensitivity on rent growth. We've got a change in sensitivity on the equity multiple. We've got a change in. So this would be the interest rate sensitivity that you look at. This is assuming 6% is maintained throughout the entire hold of interest rates, right? We're entering at a lower rate with a rate cap of 6%, but I'm trying to show what it looks like. What does the deal still look like if for whatever reason, which would never happen, but again, I'm trying to just show a sensitivity and a sort of a crystal ball, so to speak, in the event that if we had to hold this deal at a 6% interest rate and exit at a 4.6% number, this would be your returns. Again, these are very theoretical, but it's trying to just illustrate that we don't have a crystal ball, but we're trying to protect your investors' money as best we can. So yeah, the idea is that we're not selling at a 6% interest rate. We're selling in year 5, where we believe, based on the SOFR curve, it would be a lot lower than that, and it would be a lot lower than 6.4%.
Can you bring back that that sensitivity? Yes. So we're
this here. So it's the debt service, right?
So
1.24, 1.4, 1.3, and then comes back to 1.28. And obviously, I didn't.
Do you know what that implies for interest rate?
I'd have to go look in the model
yeah.
I would go dig that up, but I can dig that up.
But something similar to, I mean, because it's not that much higher than it is in year 2023. So that I'm assuming that means that there's some rise in interest rates, but you're not talking about 6%.
No, and then again, I implore people to go up and look what the SOFR curve is. What is it doing? It's a prediction into the future. We use these groups like Chatham and Pensford to give us a prediction of what they think. They've got their fingers on the pulse, and then I put that into my model to then, okay, we're starting at say 4.25%, and then we're going to go up, to 5.5%, and then we're going to come back down again to whatever based on the curve. Now the curve is purely a prediction, right? It could be less or worse. If it's less, it's fantastic. If it's worse, well, we can't go above 6%. So we're capped. And that's, again, trying to model every single scenario we can in a rising interest rate environment.
So speaking of risk mitigation.
Yep.
Can you talk about your break-even analysis? I know that's in here in the deck, but why don't we talk about that a little bit?
Was it here? There.
Yeah.
So break-even analysis is really what happens when the occupancy, if the occupancy drops below a certain rate or percentage, then we don't have enough money to pay our expenses, including the debt, right? So we have to drop to this number here, roughly 74%. Otherwise, we aren't, it's not sort of wiping its own face, so to speak. The deal can't stand on its own 2 feet. Now, what does it mean if that was to happen? Well, it means that we aren't doing our job, and that we want to, make sure that we've taken our eyes off the prize, right? One thing I will add in here, guys, is that I'm personally investing over $1 million of my own money, my family's money, into this deal. So I'm very much aligned with all the potential investors here, and my money will be treated the same as yours, on the LP side. But again, you're potentially investing with an operator who has quite a large chunk of change in the deal.
Yeah, but I'd also like to just stay on that slide.
Oh, sorry. There's another slide here that I wanted to show you here.
Okay. Oh, yeah.
So there's a change in occupancy versus the sort of the write-offs and the change in bad debt. And what does that look like? We're still projecting the cash flow even when you have very bad occupancy. Again, this is over once you come to a year 3 stabilization.
So explain what this means exactly. So at 95% occupancy, just following the gray line across 501, that's saying you're writing off 1.25% of the debt at that level. Is that
writing off meaning you have losses in your revenue of 1.25% because of bad debt, right? People not paying the bills on time. Does that make sense? So
at 95% occupancy.
at 95% occupancy,
Okay.
right? So you have an economic occupancy or whatever that might be.
And then so the 5.01% means what?
It's
What
the
is that
average
number?
cash flow over 5 years.
Okay, I got that. All right. So what this means then is that even if you go down to 80% occupancy and 2.5% bad debt and write-offs, you're still cash flowing 2.7%.
Correct.
Right. So which is not a great number, but you're still the point of this is to show that you're still making your debt service. You're
protecting your capital. Even in a worst case scenario that the deal, something happens with the deal, and again, these sensitivity analysis are really put in there to try and show a crystal ball as best we can and try and model as many outcomes. But again, we don't have a crystal ball. We're just trying to present the facts as best as we can.
But I also want to just point out sort of that, it's great to have this analysis here because it shows that, sort of even in a really, this would, to go down to 80% occupancy, you're talking about either some kind of massive economic event, plus like the management company just not doing its job.
Doing their job,
right?
Right.
And this is something that, you're probably aware of, Reed, but I think a lot of people don't necessarily appreciate if they're not like professionally in the business. Professionally managed apartments always perform better than non-professionally managed apartments. So a lot of what you see when you're talking about the market occupancy, that's the whole market. It's every asset in the market, professionally managed, not professionally managed. Professionally managed assets always have a higher occupancy rate because they have someone whose job it is to fill the apartment, and they will outcompete the other. And if you look at the statistics sort of from the Great Recession and stuff, you see that professionally managed apartments did better than the market as a whole, right? So it's kind of hard to, I won't say never. I mean, stuff can happen that we just can't predict, but it doesn't seem very likely that you would get down to that level of occupancy.
Right. And there's so many other ways you can avoid that level of occupancy, right? Okay, you're not pushing rents to your $1,500. Maybe only get to $1,400. There's other ways to offset that to keep the asset full and offer concessions and the rest of it. So look, and that's part of why the thesis of investing in multifamily, right? We're not trying to push the rents to where the average median household income can't afford it within that area. We're not trying to be the highest in the market where, $2,500 rents and something happens in employment within the area and you don't attract the right tenants. We're trying to look for cleaner, safe, affordable housing for people who want that exact thing, right? And in a higher interest rate environment, which we will add, Jonathan, is that your renter appetite will be greater because not as many people will be able to go out and buy their first time house because it costs more to do that. That's why we're quote unquote trying to recession proof our investments by investing in multifamily. And then when we invest in multifamily, look at every side of the coin, both the good side and the bad side. And these are what these sensitivity analyses are trying to show.
Any other questions from the audience? You can throw them into the chat or throw them into the Q&A, or if you have one of those way homers, where you think about it on the way home and you can't remember your question, you can always email me and we'll get you an answer to the question that you have. But I guess we've been at this about an hour, which I think flew by really fast. I thought that was really fun. But you have any final thoughts? Any things that maybe didn't come up that you wanted to mention about either yourself or the deal?
Oh, look, I think we can quickly briefly touch on timeline. If people are interested, we'll have a PPM-ish ready by the end of the week. There will be, we're looking to sort of have people funding by middle of June. And then we are looking to close the last week of June, early July, probably pushing to early July, just after the 4th of July break. I'm back out on site on Thursday, Friday with some investors. I was out on site last Monday, Tuesday. I've got a few cool video drone shots that I can send and share with the group. So, if you want to see a little bit more of the sort of behind the scenes.
And just so everybody knows that our fund that's going to be investing into the deal, our PPM will be a little bit behind. So it'll take a little while to catch up with that. But the timeline for funding the deal will still be, what did you say, mid-June? Mid-June. So
and then sort of like just I like have money in the account no later than sort of 2 weeks before closing. Right. So should something go wrong. So we're sort of really keeping on that timeline.
Yeah. And then, well, the one last question here did pop up about supply chain issues, just seeing anything, we kind of touched on it before.
Yeah, look, I think the big thing in supply chain issues are going to be, I've been reading some reports about, the shipping construction starts. So there's just a big, like, I don't know if you did you ever read the article that, Home Depot bought their own ship back in the day, like back in the pandemic? The reason they bought it was because they wanted to control it, right? Because there was not enough ships on the ocean. So there's going to be more ships coming back to the ocean. What more ships means more options, and then the cost will come down. I'm constantly in contact with my Asia suppliers, talking in and around that stuff. But everyone's at the mercy of that. I think we've seen the peak, and we're now starting to back off on that, and we're still getting good savings on our product.
Yeah, I think the thing, the issue is like you can get the product, right? So it's not an issue of like you're going to get stuck without it. It's not like the height of COVID where you just couldn't get stuff. You can get stuff. But I think the other thing that's just, as we've touched on a couple of times, like most people can't get it as cheaply as you, right? So even if it's costing more, it's not costing as much more, right, as it's costing everybody else. So that gives us kind of an unfair advantage in the market as compared to people who, have to pay retail for this stuff, which we're not. So
that's right.
Yeah. All right, awesome. Well, really, thank you so much. This was a lot of fun, and we will all be in touch. If you guys, like I said, if you have further questions, please email me. We'll get them answered for you. Our timeline of the PPM will be a little bit delayed, but that doesn't change anything. And for those who have, who are wondering, if you're coming in through my fund, the returns due are exactly the same. There's no difference whatsoever. We're not taking fees out of what you get paid. It's passing directly through to you. So that's it. Yep. So thanks, Reed, again, and I'll be talking with you soon, I'm sure. And I hope everybody else who's on the call has a great day.
See you guys.
Take care.